What is the best way to start building credit when traditional credit card companies keep rejecting your applications? For millions of people, trying to establish or rebuild a credit score feels like a frustrating catch-22. You cannot get approved for a credit card or loan without a good credit score, but you cannot build a good credit score without having an active credit account. If you have no credit history or are working to recover from past financial missteps, traditional banks often view you as too risky. This leaves you trapped in a cycle where buying a home, financing a car, renting an apartment, or even qualifying for reasonable insurance rates feels completely out of reach. Fear of high interest rates, hidden fees, or getting trapped in a cycle of debt keeps many people from even trying to fix their situation. This is where modern fintech platforms like Kikoff aim to change the game by offering a low-risk, affordable gateway into the credit system. Understanding how Kikoff works, how it targets the key components of your credit score, and how to use it strategically can help you take control of your financial future without taking on unnecessary financial risk. To understand why Kikoff is effective, you first need to understand how credit scoring models evaluate your profile. 5 core factors determine your credit score: payment history, credit utilization, length of credit history, credit mix, and new credit inquiries. Payment history is the most critical factor, accounting for 35% of your score. Lenders want to see a consistent track record of on-time payments over a sustained period. Credit utilization accounts for 30% of your score and measures how much of your available credit you are using at any given time. Keeping your utilization low, ideally below 10%, signals to lenders that you are not overleveraged. Length of credit history makes up 15%, while credit mix and new credit inquiries account for 10% each. Traditional credit cards make it easy to accidentally ruin your score through high utilization or missed payments that trigger massive interest charges. Kikoff addresses these vulnerabilities by structuring its products to directly target payment history, utilization, and account age while eliminating the risk of revolving debt. Kikoff operates primarily through its flagship feature, the Kikoff Credit Account. When you sign up, Kikoff provides you with a revolving credit line, typically starting at $750, without performing a hard credit check. This means simply applying for Kikoff will not lower your credit score. Unlike a standard credit card, this line of credit cannot be spent at physical stores, used for cash advances, or spent on everyday impulse purchases. Instead, it can only be used within the Kikoff ecosystem, such as purchasing low-cost digital financial education materials or paying for the service's monthly plan. For example, under a basic $5 per month plan, you make a small, predictable payment each month. Kikoff then reports this $5 payment and your $750 credit line to the major credit bureaus every month as an on-time payment on an active line of credit. Because your monthly balance is extremely small compared to your overall credit limit, your credit utilization rate remains exceptionally low. Using $5 out of a $750 credit line keeps your utilization rate well under 1%, which immediately benefits the utilization portion of your credit score. At the same time, every monthly $5 payment adds another positive mark to your payment history. Because Kikoff charges 0% interest and has no hidden fees, you're effectively paying a small, fixed fee solely to build positive reporting data on your credit report without the danger of accumulating high-interest debt. Beyond the basic credit account, Kikoff offers additional tools designed to optimize other areas of your credit profile. One significant feature is rent and utility reporting. For many people, rent and utility bills are their largest monthly expenses, yet traditional credit bureaus historically ignored these payments. Kikoff allows you to link your accounts so that your recurring rent and bill payments are verified and reported to credit bureaus, turning existing household expenses into credit-building assets. Kikoff also provides credit monitoring services directly within their app, allowing you to track your score changes over time and identify errors on your credit report that might be holding your score down. To get the maximum benefit from Kikoff, you should follow a clear, actionable strategy. First, set up automatic payments immediately upon opening your account. On-time payments are the foundation of credit building, and missing even a single payment defeats the entire purpose of using a credit builder tool. Second, keep the account open for the long haul. When you first open a new account, your average age of accounts may drop slightly, causing a minor, temporary dip in your score. However, as the account matures over 12 to 24 months, it becomes a solid anchor that raises your average account age and establishes a lengthy payment history. Third, view Kikoff as a stepping stone rather than a permanent destination. Use Kikoff for 6 to 12 months to establish a solid foundation. Once your score improves into the fair or good range, you can leverage that progress to qualify for a traditional secured or unsecured credit card, further diversifying your credit mix and strengthening your financial profile. By using Kikoff consistently, automating your payments, and staying patient, you can systematically remove the barrier of a low credit score and unlock better financial opportunities. With that said, thanks for watching, and until next time.